Does whole life insurance actually work? I'm specifically talking about the cash value. If you're interested in a whole life insurance policy and you want to maximize that cash value, that's why you're choosing to take out a life insurance policy, right? Of all things, all areas to put your money, life insurance, you're interested in the cash value component. When I look at the core benefits of a cash value life insurance policy, they are safe, liquid, tax-free area to position money. The thing is, when we ask this question, does whole life insurance actually work? There's a difference between what I see on paper, an illustration. So when you first look at that proposal, here's money going into a life insurance policy. I see on the illustration, it's referred to in the industry, my payments going in. Here's my cash value build up over time. Then I've got my death benefit. An illustration will look different depending on what company I'm looking at. Here's a quick sample of one page of a full illustration. In our next video, we're going to take a look at this policy. This was a policy that was issued in 2017. So we're going to see what was projected and then what actually happened. It'll serve as a nice follow-up to this video. But to get back on track here, you're proposed this illustration. You see money going in, and here's the cash value build up over time. Let's pretend for a moment that you're paying in $15,000 per year. And this is a policy not where you're told, here's $1 million death benefit. It's going to cost you $15,000. We don't want to take that approach. Instead, you're saying, I want to pay in $15,000 per year. And as I continue to make those payments, I see by year 10, let's call it, I have $200,000 in total cash value. So if you've paid in $15,000 per year for 10 years, and now you have $200,000, that's a $50,000 gain. And I'm just using a general example here to simplify things. But on paper, okay, here's a safe area to position money. It's liquid. I can access my money while it continues to compound. I have life insurance as well. Sign me up. I'm very interested in this. But here's what often happens. I take out a policy expecting this, but then reality strikes, and what was on paper on that projection does not actually happen. In reality, I've made my $15,000 per year payments for 10 years, a total of $150,000, but my actual cash value is closer to $130,000. Why is that? This happens quite a bit. I remember several years ago connecting with someone who had purchased a policy in 2007. He had been paying about $24,000 per year, exactly $24K, $2,000 per month, since 2007 when he started the policy. And he stayed the course, continued to make payments. I connected with him. It was something like 2015, might have been a year earlier or later, but several years after the fact. And he was upset because when he was sold the policy, he was really, in his mind, led to believe that the non-guaranteed values, what that illustration showed, is what he would have in cash value. However, as he examined the numbers, he was a numbers guy, he saw that the actual performance, when reality struck, it was closer to the guaranteed values. And then as he looked at that in-force illustration, which is a projection of future values based on what you've already paid in, and if you're still making payments, what things will look like, he said, I see the guaranteed values, and then the non-guaranteed values, which are like twice the dollar amount, they're like double the value of the guaranteed values over time. Why should I expect to believe that all of a sudden this policy is going to deliver the non-guaranteed values? Because it's done closer to the guarantees and I don't want it anymore. And to answer that question, he had no reason to believe it, and the policy wasn't performing due to the design, which we'll hit on in a little bit. But reality often strikes, and these products can under-deliver, and this is often what results in consumer dissatisfaction. I tell you you're going to have $200,000. I, as the agent, believe it because I see that illustration. The company's dividend rate has been solid. The dividend rate history over time has been solid, but then it under-delivers. I don't know why. You as the consumer don't know why, and we're wondering what's going on. But then I can take that exact same policy where you pay the exact same dollar amount in, call it the $15,000 per year going into a policy for 10 years, and you have $200,000 after 10 years, or very, very close to that original illustration. Perhaps it's $185,000 or $190,000 if there's been a dividend adjustment over the years. Keep in mind, options A and B here are the same company, same product, same out of pocket on your end. The difference, however, is in the design. Now, what I mean when I say that is when we design a policy, you, the policyholder, not the agent has to do this, but you can actually decide where your money goes. Which with an insurance policy, we typically think, well, I've got an insurance policy, so I pay a premium, and that's it. However, with a high cash value life insurance policy, there are two main areas where your money can go. You can direct dollars toward either the insurance premium dollars first buy life insurance and then eventually show up in cash value, or you can direct dollars toward what is called a PUA rider. Stands for paid up additions rider. I like to refer to it as a cash dump-in. In summary, premium dollars typically do not build cash value in the first year, sometimes the first and second year with most whole life insurance policies, where PUA dollars immediately build cash value. That's money I see right now, I can access it right now, beefs up the guaranteed values, I see my equity there, and what we've seen to be so consistent, this is what corporations do, by the way, the more money that goes here, just when I look at balancing a policy properly, like if I'm going to pay $1 in, how much of that dollar should go toward premium and how much should go toward PUAs? As much as we can possibly put there is typically the answer. When that's done, meaning we beef up the cash value as much as possible, that's typically a case where we see the strongest actual values. When we look at reality, things look as good as it can possibly be, or as good as it gets, we should put it that way. So the question begs is, all right, if I can control that, the design of the policy, if that's the difference, that's all well and good. I know I should design a policy properly, but if this can happen, I can get a policy where it projects 200,000 and I have a lot less. Like, I don't want that. If I'm you, if I'm looking at a policy, my question would be this: what's in my control and what's not in my control when it comes to actually seeing cash value growth? Because the more money I have in cash value, if you've got an intention to use that policy for anything, whether it's borrowing, retirement down the road, whatever, the more value you have, the more working capital you've got to actually work with. So what is in your control and what's not in your control? A cash value life insurance policy, a dividend paying whole life insurance policy, is not like other assets or other investments. Life insurance is not classified as an investment. It can be classified as an asset class just when you look at compliance and industry regulations. But it's not like mutual funds or another account where I can rebalance my portfolio, put some money into fixed assets, take on risk elsewhere. It's really whatever the insurance company is doing, it is what it is. The net growth rate, the internal rate of return on a properly designed whole life insurance policy will produce somewhere between 3 to 5%. As a safe area that you can access anytime you'd like, what a lot of people do is put money that's typically just in cash or other fixed assets into cash value life insurance policies, or into a cash value life insurance policy. They've got that 3 to 5% net growth rate over time. They can access the capital for other opportunities, knowing that they continue to earn that 3 to 5% as if they never touched it in the first place when you look at how policy loans work. But what's in your control and what is not in your control? So, as far as what's in your control here, a couple things. And I'll begin with this. The design of the policy. So we hit on that before, money going toward premium and then PUAs. You, the policyholder, can elect that. All companies have different limitations as far as how much money they'll allow us to add into that PUA rider on top of the base premium, but we can control that. And then also, what that has a direct impact on is compensation. So that's working with the agent that's designing your policy in designing a policy properly. But what you'll see, just to summarize this, if a policy has maximum cash value, particularly upfront, that will result in minimum commission. As a result, sometimes you will get resistance when you ask for a high cash value policy, meaning you want more cash value upfront, simply because it reduces compensation. We hear things such as, oh, if you take less upfront or if you take more cash value upfront, you're harming the long-term performance. That's not true when you look at reality. Perhaps sometimes on illustrations, but when you look at reality, the more cash value I have up front, the more cash value I have when I look at the guaranteed values, the more money I have in reality. When we look at strong historical data of policies that have actually lived the test of time. So guaranteed values, how we can control that is really through the design of the policy. What we like to look at when designing a policy is what design gives me the most overall cash value on a guaranteed and non-guaranteed basis. And then look at the designs that have been proven over time in producing strong actual results, not just projections that should produce good-looking values, and then they don't, and then I have to come back to you and say, well, because of some of the adjustments in the company's insurance expenses and the decline in dividend rate, you've got a lot less money than what you had planned on. It's like, that's not okay, right? This is why we've got to be upfront with this kind of stuff. It's people's money. And then the other big thing is company selection. If you've seen any of our videos, you know my preference here, 4 major mutuals, regardless if you work with us or not. Always make sure you at least ask about those 4 companies, being MassMutual, Guardian, New York Life, and Northwestern Mutual. Simple reason being, they've consistently delivered the strongest actual cash values to policyholders. When I say actual cash values, I'm talking about reality. Back to reality. So that's what we can control. What about what we cannot control? This is important here. The dividend rate. I can't control a company's dividend interest rate. We can't control it at all. Whatever that dividend rate is, that will be applied to all whole life insurance policies with all policyholders for that company. The dividend rate, it kind of is what it is. It adjusts annually. Dividends are not guaranteed, but typically they are paid, especially when you look at any A-rated mutual company. If you look at the 4 major mutual companies, they've all been around for over 160 years, and they've all paid dividends for, I think, over 150 years, something like that, a very long time when you look at it. How that dividend rate works, a couple things I want to touch on here, is if I have a product that has a guaranteed rate, let's say of 3%, and the insurance company I select, if I go Google search them and I see that their total advertised dividend rate is 6%, what that actually means is the surplus rate, which I typically will not see this terminology, but the surplus is 3%. So the guaranteed rate plus the surplus gives me my total dividend interest rate, which I will see online or in the company's literature if they disclose their dividend rate. But the surplus piece is not guaranteed. The guaranteed portion is. For example, though, or where I'm going with this is if I see a dividend rate of 6%, it's not 6% plus the guarantee of 3%. It'd be nice, wouldn't it? I wish it was, but it's not, unfortunately. So that's one thing. And the other thing, I should erase that, but that's okay, is a dividend rate, let's use the dividend of 6% again, is not what you're actually earning on your money. So if you've got $100,000 in cash value, 6% of $100,000 is $6,000. So will you see $6,000 of growth on your policy? The answer is no way. That'll never happen. What we want to look at here is what is referred to as the internal rate of return. So a dividend rate is a gross rate that is always credited after the company's insurance expenses, mortality charges, everything that comes with the life insurance policy. So if you simply want to see what is my cash value growing by and can you actually plug a rate on it or associate with a rate, the answer is yes. Right? Internal rate of return is the terminology used in the industry, growth rate on a life insurance policy. In the early years, it will always be negative with most whole life insurance policies, that is. If I've got a 6% dividend interest rate, I'll see that internal rate of return in most cases top out somewhere between 4 and 4.5% net. And remember, that's a safe, liquid, tax-free area to position money. Just to kind of say, it is what it is. We don't want to try and pretend that it's something that it's not. So that's the dividend rate. We can't control the adjustments there over time. Rider fees Rider fee adjustments. So for example, if I have a PUA rider, if I have a term insurance rider, often I have charges and fees that are associated with those riders on a policy, and the company does reserve the right to adjust them. It's very rare, but in most cases, the company does reserve the right to adjust them. You'll see the terminology referred to as the guaranteed maximum charge. So if the company elects to increase fees on a PUA rider, that can have a negative impact on my cash value. I'll still see positive growth, but it will be at a slower rate than what it would have been if they just kept their fees where they presently are. With whole life insurance products, especially with the bigger companies, I usually don't see those increases. However, it is possible they have it in the contract for a reason. So it's important to disclose that up front. And also, because the company can adjust it, we cannot control it. It is in their hands ultimately. And then cash value allocation, which we kind of hit on this earlier. And all that means is if you've got a dividend paying whole life insurance policy, it's tied to the insurance company. So your performance is reliant on where they're placing their money. We've got a ton of content regarding that covers where insurance companies position their money. For a long time, they've been very, very heavy in bonds. We have seen the bond allocation gradually decrease over the past decade, a little bit more than the past decade, where they've been positioning their money. You'll see high-end commercial real estate. We'll see a lot of money going toward other businesses. So for example, you'll see insurance companies such as Mass Mutual have a venture capitalist division where they are outright acquiring or investing in other companies. Really, with an insurance company, what they're looking for are safe assets that allow them to maintain a AAA safety rating. So safety ratings are very important for them. How do they maintain strong safety ratings, meaning they can't take on risk, and still generate an attractive return, really for themselves as a company and then policyholders? That's what they're looking at there. So that's really what my performance is going to be based on. The cash value allocation, I can't say, hey, the market just tanked. Let me put all my money in the S&P 500. If you have a policy with an indexed rider, which some whole life insurance products offer this, of the major mutuals, Guardian does, smaller companies, a couple of them out there also offer this, and you can go back and forth between the dividend option and the indexed option. And I just want to emphasize the point, it's still a whole life insurance product with a guaranteed rate that exceeds the insurance expenses. That's much different from a universal life product, just when you look at the difference between those two. But a lot of additional information here, just hitting on the point that we cannot control that at the end of the day, those aspects. So, does cash value life insurance actually work? Well, yes, if the policy is set up properly, if it's with one of the major mutual companies where we've seen proof. We're going to look at some proof in the next video with a policy that was not issued that long ago in 2017. We've got several videos and a lot of content that displays older policies that were issued a while back in the 1970s, 80s, 90s, and early 2000s. But we're going to look at a more recent policy in a declining dividend interest rate environment to see what has the actual performance been, and we're going to compare it with the original illustration. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.